Here we go.
Good evening, Stephen. It's Francis Hunt. Yeah, how are you? Nice to be talking to you finally.
Good, very well.
To all my audience, I want to introduce Steve Keen. Stephen is a professor at Kingston University, and he is also the author of Debunking Economics and Can We Afford Another Financial Crisis? Now, I've watched and monitored.
We can't afford, but the question is, can we avoid one?
Can we avoid one? Let me get that straight. Let me restate. Can we avoid another financial crisis? We certainly can't afford it. My blunder there. Stephen, welcome very much. And you've had a very long day, and it's 9 at night. So massive thank you for making the time out for having a chat to me and your audience. Why don't I just give you a little bit of a looseness and say, can you encapsulate, maybe give us the flyby 2.5 minute take of where we currently are so that everybody just understands where we are on the map and what are the key issues that we need to think about?
Okay. Well, we've been living in a credit bubble for the last 40 years without being conscious of it. So a large part of economic performance really since the 1970s has been driven by a runaway bubble in private debt that's financed asset bubbles around the world, particularly, of course, the housing bubble in America and countries like Spain and Ireland as well. And now we're about a decade after that crisis first started to bubble up. This will be the 10th anniversary this year in August 2007 at the start of the crisis. And we now find that a large number of countries that experienced that crisis are what I'm calling in the book, the new book, I'm calling the walking debt of debt. So they have a private debt bubble which bursts. They've now got an overhang of too much private debt. One consequence of that is there's very little credit-based demand in those economies, so they're stagnating for that reason. And then there's between 9 and 15 countries that appeared to avoid the crisis, the worst of it back in 2008. And that's in particular as Canada, Australia, South Korea and China. And those countries managed to avoid the crisis by continuing to lever up. Various means they encourage the private sector to continue borrowing. They're now about to go from being having avoided the crisis, they're about to be the zombies to be, who have a crisis now with a much higher level of debt than they would have had they had a crisis back in 2008. So that's the situation we're in economically. Ecologically, another story. I think we're on the brink of finding out just how badly we've damaged the ecosphere. So the combination of a financial crisis in the middle of ecological long-run catastrophe as well.
Wow. I think that's probably one of the better and quickest, succinct encapsulations. It's interesting that you single out certain nations for having kind of bypassed. They were benefiting from a bit of a China commodity buyer of last resort boom during the 2009, 10 into 11 before we topped out, and then all the commodities started to fall. And are they going to fall that little bit harder for having missed some of the is there a relative degree of pain that will be higher for them, or is the nature of this just being so global and so macro and a first for economic history? Because if we think of the depression of the 30s, yes, there was a European element to it, but it was very strong in America. There wasn't that global tied in, that relation. How will it be worse for them, or does it not matter if we allow it all to go on? It's going to be all fall down anyway.
Well, first of all, let's compare it back to the 1930s. You're right, America was an outlier in the sense that it had a huge private debt bubble. We all know about the Roaring '20s. We've all seen The Great Gatsby. Yes. And as part of that, we know that there was enormous amounts of credit frivolity finance back then that led the stock market boom and bust. And then you had the crash in 1929, leaving lots of people like Irving Fisher, for example, with margin debt where they might have put down $10 million, is roughly what Fisher himself put into the market, had $100 million worth of shares. No problem as long as the share prices continued to rise. When they crashed, of course, they were wiped out. We then had the Great Depression, the disaster in Germany and the Second World War, all flying from that. But, for example, if you look at the UK, it didn't have anything like the same debt bubble that the Americans had, and it didn't have as bad a 1930s as the Americans did, nor the Germans. This time round, America was again first in, but there were other countries that joined them at the time. Europe in particular had a private debt bubble that it's still not conscious it had. The UK as well, Ireland obviously, and Japan had one back in the 1990s. And what really has happened now is with globally deregulated finance, and my profession, so-called economics, played a major role in encouraging the deregulation of finance and the accumulation of power within the financial sector itself. That's led to the stage where virtually every country in the world has had a debt bubble. And the only reason there wasn't a uniform decline back in 2008 was that some countries like Australia, the governments encouraged the household sector to continue borrowing. And then, of course, China was suffering an enormous downturn, its first capitalist crisis. And the export demand for China fell by about 40%. That caused a huge dislocation because there are so many workers who don't actually have the right to be in the city on the coast, but that's where they're working. When they got made unemployed back to the countryside, a huge political turmoil for China. So China, because it's a communist government, if a communist official tells you to do something, it's extremely good for your health to do it. And they basically told the banking sector in China to lend to anybody with a pulse. So at the same time as you had minor government-driven recoveries of credit in countries like Australia and Canada, you had this enormous government stimulus or government-mandated private credit stimulus in China. That's now run out, and with the countries that managed to get lifted by that Chinese boat over the crisis in 2008, and now in the case, for example, in Australia's case, have a level of private debt that's about 30 or 40% of GDP higher than it was back in 2008. So they're going to have more of a crunch than they would have had they let the crisis run through in 2008. But the big difference for the globe overall is that the scale of the government sector now, after the Great Depression, is literally about 5 times what it was before the Great Depression.
Yeah,
we've got so used to the government being a substantial part of the economy, but the government back in the Great Depression was 1/5 the percentage of. So what that means is when there's a private sector downturn, even if the government tries to run a surplus, which is some governments are attempting to achieve that as though that's a good idea, they still run a deficit, which provides some cash flow that enables private individuals to repay their debts in a way they wouldn't otherwise be able to do. So we don't go as deep as the Great Depression because there's more of an air conditioning effect from the scale of government spending. But it's more likely to be intractable because, as we've seen with Japan, you don't write the debt off either. The private debt still remains there. The government spending enables you to keep on going, but you never quite clear the decks, as was done by the combination of the Great Depression and the Second World War.
Yeah. I totally get that. I find myself asking when I hear someone encapsulate it as succinctly as that, is that the entire equity boom market, so we have a lot of traders and people that have participated in various asset classes, the whole 80s, 90s that has continued on and is still running today, yes, it's had certain setbacks, has all been driven, it's all an asset appreciation, inverted commas, that has been driven on this massive expansionary debt, of which Greenspan, who then later called 2008 a black swan, is probably the most prodigious architect of liquidity provision. How much of our current economic history that we're actually participating in is not affected by this ever escalating expansionary universe of debt creation? I mean,
it's all affected by it. The one thing which has happened, which is different after this crisis, is that any financial crisis is driven by an increase in credit, which is change in private debt. So you then get the credit enables more spending to occur. This is what mainstream economists completely fail to understand. So that credit gives you a boom. And then when the debt level gets too high and either companies stop wanting to borrow or lots of ventures fail because they're overgeared, or banks stop wanting to extend as well, then you have a crunch because the rate of growth of debt drops, credit demand falls over, and the economy collapses. So that's been the global. That's the particular pattern we've had time and time again. One reason why it's gone on so long this time is the mainstream profession, including especially characters like Greenspan, argued you don't need to worry about private debt. Ignore it. And yet, back with the Great Depression, Irving Fisher said we were in a debt deflation. And you would think we would have learned from that experience, but we have unlearned courtesy of the economic so-called profession.
And is it not the case that we've pushed the cost of that credit, certainly in terms of housing, probably as low as it can go? I don't think those low interest rates, all the benefits have been passed on to the consumers in quite the same way. I know credit cards are still charging 27% to certain profiles, etc. But if we just take the fact that at the central bank level to the bank level, we've run out of runway. Isn't it the beginning of end game, or does this entire concept of negative rates really have leeway?
Now, negative rates are nonsense, and this is one of the indications of how little economists actually understand about money. Because people who trusted economists as experts would have automatically thought they're experts on money because, hey, isn't the economy about money?
Yeah.
But they in fact persuaded themselves with a priori arguments, reasoning logically from a stupid starting point. They reasoned that, well, if you double all prices and double incomes, you wouldn't change people's consumption, which is true if nobody has debt. But as soon as you have debt, then doubling all the prices and doubling incomes, what do you do about the rate of interest? You increase it, do you halve it? It's one of those things where you necessarily have a redistribution coming out of doubling all prices or causing inflation changes the debt burden. It benefits debtors. It penalises lenders in that sense.
Yes,
so
savers.
As soon as you take into account that a priori argument to not even look at credit goes out the window, and then they don't realise the role that banks have in creating money. So they have a pretend model. I call it. They've got what I call the Ashley-Madison theory of banking, and that is that banks can actually originate money. Banks introduce you to somebody else who will lend you the money, and they charge you a fee for the service, a bit like Ashley-Madison. Yeah. Ashley-Madison doesn't actually provide sexual services, but they can introduce somebody else who may be interested in doing this in a mutually beneficial arrangement. That's the conventional model of banking. Now that is nonsense.
Yeah.
There's been
many people believe there's a saver for every lender, but of course that's the Ashley Madison model, and it's completely fake. I think that's getting out more, that people realize that banks actually are manufacturers and are creating money. But right. I don't think the repercussions and full effect of that is getting out. Hence why the discussion on negative rates.
That's why I'm working on trying to educate the public and my own profession about the role of credit, because once you say banks originate money and debt, so rather than lending existing money, they're creating new money. When they lend, you don't take on the money so you can be in debt to the bank. You take it on so you spend it. So when you borrow that money, you spend it, and that actually adds to demand. So credit adds to total demand above and beyond what comes out of the turnover of existing money. And then if you then have people repaying their debts, so that spending they would otherwise have done gets redirected to paying debt down. So positive credit expands demand, negative credit contracts demand. And that's exactly the process we've been through.
Correct. And if we just look simplistically, they've expanded the total quantity of money available through the QE policies, but the access to that money has not been democratically through all people. It's gone via the banking system, and as a result, we've not seen it go to all the different places. Plus, the velocity has dropped, and the pricing has dropped. So what is the net effect if we're thinking about all of this? Yes, they've tried to deal with the drop-off in demand and some retiring of debt maybe. They've dropped the price of borrowing to try stimulate it. They've run out of runway. They can't go much lower on that, and the velocity has fallen, even though they've upped the volume. So is the velocity falling with the same degree? That's why we continue to have this sort of heavy, boggy, what I call post-depression economy.
Yeah, it's a natural thing too if you think about it. If you have debt and you're spending you've got cash in the bank, but you've also got debt, and you are worried about the capacity to repay the debt, then what you tend to do is to spend the money less rapidly so that you accumulate more of the cash that currently exists in the economy in your bank account. You're trying to save as an individual. What that actually means for other people is because you're saving, you're spending less, and your spending is income for other people.
Yeah.
So your act of trying to individually save actually reduces GDP, reduces total demand. And that's the catch. That's what Keynes called the widow's, or the paradox of thrift.
Yes.
A thrifty individual makes plenty of sense of you're self-sufficient. you're putting aside coconuts for future famines. But if you're thrifty in a capitalist economy, your thrift actually reduces other people's income.
Which brings the demographics argument in Japan in, with the aging population and the whole boom. You're probably familiar with Harry Dent, who models on the age and says, well, the life stage cycle of your biggest bulge, the pig in the python kind of concept, will dictate what people are doing. And as that pig is more and more life stage cycle of saver and no longer spend. I think it's 47. You're your most tax useful and probably your most expenditure orientated. You're putting children through university, you're paying a mortgage, etc., etc., etc. And then later on, you become a net saver. You be more frugal. You maybe go for the odd little cruise, but your life stage cycle is going through, and it becomes more medical of nature as well. And with the baby boomers in mind, don't we face a big fall away in, if we just look at America, because it's such a big dominant market, don't we face that natural reduction in demand as well, on top of the fact that we already have an overhang of leverage knocking around? So isn't this quite a dull, dark, grey season for demand in terms of North America particularly?
Oh, yeah, it is. I mean, we're having a global population slowdown. If you look at the two drivers which are going to increase output in an economy or increase demand in an economy, one is population growth and the other is improvements in productivity. And if population growth is going negative, then you might still have the same per capita rate of economic growth, but you have a lower aggregate level of economic growth. So if you set that as a target, and you're used to having a rate of growth as we tend to apply in the 50s and 60s in America of about 3% of GDP per annum, about 1% of that was due to population growth.
Yeah.
Now, if you no longer have population growth, then you're going to say, well, 2% is your ceiling. So in that terms, if you're actually looking at the national level and ignoring GDP per capita, you're going to get a lower rate of growth coming out of it. Yeah. But also, as Harry argues quite validly, there are demographic humps as well. So the baby boomers themselves caused an enormous expansion in demand in the 50s and 60s. Now that they're retiring and dying, and the population below them is not a bulge but a shrinking, then you have a lower tendency for growth coming out of the demographic triangle all the way through.
Ah, fascinating. So there's a ripple, there's a knock-on effect even of their lack of consumption. In other words, it creates less demand, and everything is a self-feeding mechanism in essence. And then we take into account the bequest of this huge debt overhang and all the Medicaids that are starting really to become a problem as all these people come into the medical claiming years. So you have these unfunded liabilities that are commitments that need to be renegotiated. Is there really an easy way to get out of this? And what, in your sense, and I do know you have a vision, and I want to give you the opportunity to talk about it in terms of what I think you call almost a debt moratorium, where everybody gets money, but you've got to work your way around the agency issue of giving positive enforcement for negative behavior. So everybody gets, including those that are indebted. Tell us a little bit about, is there a way that it doesn't end badly on that, and then lead into your possible solution, if you would?
Well, I think the bleakness is really coming out of our inability to understand how the economy actually functions. That's one of the absurdities of all this, that if we actually realised the way in which banks create money and the way government can also create money, then that particular fraction of our problems would disappear. And we'd be happy to do the type of debt reset that I'm talking about, because we wouldn't be regarding debt.
Just on that point, interjecting slightly, do you think that's active by design or just through incompetence? Because we have very little training in school on the concept of money and how it's created, and it's very much has to be self-sought and found out and discovered. If you're not seeking it out, it's not throwing itself at your feet, is it?
No, it's certainly, it's one of those, it's rather opaque, and the reason it's opaque is that it's rather like if you're looking up at the sky, if we didn't have astronomers who'd taught us that there's such a thing as gravity, and that the Earth is, even though it appears that the Sun orbits the Earth, in fact it's the other way around. If we didn't have the astronomers who'd done that serious research back in the 1500s, our natural inclination was to say, well, the Earth must be the centre of the universe, because look, we can see the sun spins around us every day, so does the moon, and the stars rotate. There are these funny things that planets that don't quite do the right thing. but we must actually be at the center of the universe because our eyes tell us that's what's happening. Now, unfortunately, you normally rely upon experts to disavow you of naive notions. But in economics, the so-called experts amplify that naive notion by having a totally fallacious vision of how money is created and its role in the macroeconomy.
Well, yeah, I've seen worrying things about Paul Krugman's ability to grab that, yet they seem to be...
he's totally off the planet. I mean, he's no respect for him whatsoever because in many ways the central banks of the world are sending messages to him saying, wake up, Paul, and he's continuing to remain asleep. The Bank of England, of all places, the Bundesbank, and most recently the Bank of Norway have all come out and said, effectively saying the model Krugman pushes, which is called loanable funds, where banks are the Ashley Madisons of debt, is simply wrong.
Yes, and I just find they seem to get a higher pedestal to talk from, the more inaccurate they appear to be. Someone like yourself, who incidentally, while at this point, let me just tell the readers, and we'll refer to this at the end, Steve runs a Patreon channel on his YouTube channel, which is where you can sponsor his cause if you believe in what he's saying and the direction he can take you on. The university doesn't stump up the cash for all of that, and it doesn't end up where it should. And if you like what Steve is saying, and you're going to hear plenty more, I'd certainly encourage you to find it It's under Patreon. Where will they search for you, Steve Keen, under Patreon, Steve?
You search for my name, you'll find me there, but it's Prof. Steve Keen at Patreon. So Patreon is for those who haven't heard of it before, it's like Kickstarter or Indiegogo. It's a crowdfunding site, but rather than being crowdfunding a particular project, you crowdfund a particular artist. So you might find Beyonce's on there possibly. And but in my case, I'm trying to be the world's first crowdfunded economist because the universities do finance economists, obviously, but the money goes to the dominant sect, the neoclassicals, to get the best universities and the best funding. There's only a dribble of money at low-rank universities left over for non-orthodox people like myself, and I've basically had enough of it. So I'm going with the
especially if you're singing an unconventional tune, which to them appears unconventional. Yes, it seems eccentric to them, which of course it isn't. It's just far closer to the reality. How do people? This is the big question. In terms of giving people, and I'm not a regulated financial advisor, and neither are you, so this is all just our view in what is an entertainment program that hopefully has some value for people. How do people, on the basis that they are going to continue with the current path and trajectory they are on, how do they best prepare themselves to come out the other side at least better off than the multitude that are likely to be punished by this escalation and probably blow-off event that's going to lead to probably a 2008 cubed as an economic knock-on event?
I won't see it as being as big as 2008 because the economies that are going to suffer it collectively are just the size of the American economy, not America plus Europe. And if we look back at 2008, that was America plus much of Europe. But nonetheless, they're going to have a big crunch. And the way that you avoid a problem is you be out of debt. That's fundamentally the problem. Now, that one, if you then
when Steve says that, what he means is don't be an investor in bonds or any other debt instruments rather than your credit card debts. You're talking personally.
Leave it debt. Yeah, it tends to be the problem. But certainly, like if you have to be able to service whatever assets you own with your income flow, and you can't afford to be fragile on the income flow. No. So you can time these things. We can ride a bubble. I mean, I deliberately did not ride the housing bubble in Australia. Probably, personally, for a financial reason, that was a poor decision. I should have ridden the bubble. I certainly saw when it was starting. But once you ride a bubble, the most important thing is to get off before it breaks. Yeah. And I've forgotten who it is, but one classic investor said that the secret of success is I got in too late and I got out too early. Now, that's far better than the other way around.
Yeah, indeed. And it's not how much you make, it's how much you keep.
Exactly.
In these things are very much about the game. So, I mean, if somebody, let's say we have an Australian, which we do have, who's sitting on a number of rental properties and his rents are just about washing their face, he's having to do a bit of top up, he's spending everything, he's literally got just a bob or two left and he's leveraged to the hilt and he's got a portfolio of properties, and so far they've he's a bit late to the party, but they're just creeping ahead against what's owed on them. But in an event of a 30% overnight fall, or within a very abrupt time frame, he would be deeply underwater, and then possibly he'd lose some work, and then he could be pushed over the edge. How should he be exiting the market and scaling back?
Yeah, the main thing is to get out before everybody else does. I mean, the old story of the life raft, the first person in the life raft is more likely to survive than the last. So it is a case when there's looking like there's going to be a break, then get out before the break happens. And on that basis, the indicator that I use is the credit accelerator, as it's known. And if you take a look at the change in private debt and see which direction that's heading in. If you have a country with a high dependency upon debt, and that's obviously countries like Australia, South Korea, Canada, China, and even Belgium and Norway and Sweden, in that situation, if credit starts to head down and you have a capacity to liquidate before that happens, get the hell out of there.
Yeah. What other? So we're out of over leveraged property. We're out of the bond markets. There's a lot of things to be escaping from. But where do you escape to, Steve, in terms of holdings? So there's the precious metals brigade. I'm also going to ask you for a comment on the crypto category, which seems to have an expanding market cap at the moment. What's your take on that as a potentially, if it has faith and it doesn't have the debt burdens that issuing nation states do, could it be a clean sheet for us to at least get on with if accepted, and any other categories that you could be the go-to, the run? And what do you think of cash? Are they killing cash? Are you going to have to take them in anyway and get the notes exchanged for binary? How do you see this playing out? So put your futurism hat on, and how do you position, and what should a man in the street do who's starting to understand the economic melee and needs to know where do I jump?
Well, it's never easy to jump. Jumping is very, very difficult. Let's put that, because the timing is always a problem. People complain about jumping too early, but it's much worse to jump too late.
So let's assume we want to jump now, and that we don't want to run the risk of how much long the music goes.
You're best in many ways and people aren't in cash are going to be forced to make distressed sales, and you can buy an asset much more cheaply off somebody in distressed sale than you do in other markets. So that's one little potential advantage.
We just had a small breakup. Sorry, Steve. We just had a small breakup on the Skype bandwidth there. Can you just say that last sentence again before leading up to distressed?
When you're in cash and other people are being forced to sell who aren't in cash and have debt to service, then you can be basically a vulture buyer of assets in a collapsed market. So that's
I
the
like
most
that.
effective thing.
I like that, but then it means buying those distressed assets where they're probably going to go sideways and down for a long time. It's difficult to get the absolute bottom, and that also means you expend your gunpowder at a time when gunpowder is premium. So. Do you really want to do that? Do you want to be buying a house when everyone's selling?
I think one of the dangers is we know the government's going to dive back and try to rescue the bubble. That's what's happened in Australia on numerous occasions. So in that sense, if you buy in when somebody's a distressed seller, you may lose in terms of the price falling even more after you've bought it. But if you buy somebody who's from somebody who's actually in a debt distressed situation, there's likely to be more of a discount on that than there is in the average market. Yeah. And then there's still potential upside there. And I would rather get people to stop thinking about buying houses as an asset. I'd rather get back to the stage where we treat housing as a consumer item you consume over a long period of time, rather than making it into a bloody asset. But nonetheless, that's what we're stuck with. They
have, particularly in Britain, it's your ATM. You buy it and then you keep levering up and buying a new car and extending the mortgage and getting that holiday. It is basically an ATM, isn't it? That we've used it.
Price continues rising.
Exactly.
It's a very, very deadly credit card when it goes in the opposite direction. But the other thing is that in that situation, I don't regard gold as money. There are lots of gold bugs out there who think money is or should be gold. It's not. But gold is a speculative commodity that does well when there are currency disturbances. So that's another reason to think about gold. Digital currencies, again, I've got the same sort of skeptical attitude. A lot of people who designed things like Bitcoin, for example, were trying to emulate gold. Now, you can't emulate gold.
No.
Gold cannot be made by any The only way to make gold is to fine-tune neutron stars and shove them together and get out of the way and collect the debris from somewhere else in the universe after they explode. Making another Bitcoin, simple. Just design your own blockchain technology and bang, you've got another rival to Bitcoin. So there isn't that guarantee of uniqueness for digital currencies. But the other thing I'd suggest doing is being aware of alternative currencies. There are plenty of people who are trying to organise alternative currency on a sort of strongly ideological basis quite frequently, wanting to have community-created money. But that money becomes much more valuable when there's a downturn, because when there's a downturn caused by a slump in the credit system, credit money tends to dry up. That alternative money systems actually thrive in that situation.
Yeah, so you're talking about a community, I suppose it could be as simple as the babysitter's tickets that then extend into someone who does any form of service in your community that then becomes established as a currency. Yeah. But that's a bit of a hard one for an individual to pull off. You need to be in a like-minded community, or you need to come into an area where there's some sort of basis of that establishment. So we've said gold may be serving as that insurance policy against fiat meltdowns. We've said hoard cash, and then we've said maybe buy some of these assets, although you've also said within that we should be viewing it more as a long-term consumer item, which kind of undermines the idea of buying in a home. But you would buy it, I suppose, for the reaction of the government. That's the problem. We're buying a lot of things for what we anticipate to have happen next, in terms of it going up in value. Are we all just, I laughed about that one Onion headline, Americans want to know the next bubble so they know what to chase and what then to buy and leverage. It was sort of like that. I mean, will I be a buyer of the property, A, because I need a property, or because it's going to bounce because the government's going to have to bail it and I can squeeze someone really hard on the way out? Do we buy crypto because we don't believe in it fully? It's not gold. It's trying to have the scarcity of gold. Hence, they're restricting the number. But it's going to become a faith-based system, and as long as enough idiots believe in it and have faith in it, we buy it and it goes up. And the banks who don't want to be caught out with the gold thing say, if we've got to have a lesser evil, we'll go with the electronic money. Thank you very much. It's not too far away from what we already know. Therefore, we buy cryptos on the basis that they're going to go up, but not because of and most people will believe in them and need a place to run. Where's the real sound?
Isn't it? It's pretty sick world. We've been trapped in a casino without realizing that's what's actually happened, and we're being encouraged to treat things which should actually be consumer items or long-term income sources as speculative objects. We gamble with each other and
for financial engineering. Yeah, in other words, we all expect it to be what's the next category of created essence or ether that's going to have financial and engineering applied to it and will likely appreciate, so that on the slippery greased pole called the current nation fiats that we're under, we somehow can find a way to get forward instead of perpetually sliding down.
What we're doing fundamentally is dancing to the tune of the banks.
Yeah,
the banks often don't even know that they've got us by the Pinocchio strings, but that's the sort of world we've ended up in. Now, what I'd rather do, rather than talk about how individuals can survive this, I'd rather say, let's see what collective redesign we could do.
So let's do that right now. I needed to ask the question for the individual, because a lot of those that will be listening, what do I do? But they also need to understand collectively we need to bring forces to bear to actually change the nation of the game, so that it stops being what's the next ramp. So go ahead with your solution, Steve.
Yeah. Well, banks create money by creating debt, and what they've found is the easiest way to do that is to lend in a collateralized way, to lend against an asset. So even if you don't have the cash flow from your company to finance the asset, if you fall over, the bank gets the asset. And what you then have is banks being able to exploit a social privilege, because being able to create money is literally a social privilege granted by a banking license, and they're abusing it. Yes. They're abusing it, first of all, by creating it for frivolous reasons such as speculation. And
one of my bugbears, you hit on one of my bugbears. Sorry, Steve, to cut in. You hit on one of my bugbears, is that the nature of securitization sees it all be about the assets, and hence we get asset bubbles. They're not entrepreneur enablers, providing business plan backings to things
Now,
where the tangibility is human capital and human ideas, and that's the other.
Partly in that front, I'm going to excuse the banks on that front, because if you actually want to be funding entrepreneurs as a bank, then you might have, say, 5 entrepreneurs who all got this great idea in solar cars. Which one is Elon Musk?
Yes.
You don't know before the whole thing happens. So in that sense, it's quite likely you're going to lose your cert on 4 out of the 5. If you make money on the 5th, all you get is an interest stream.
So can we blame them then? If that's what we're asking for productivity,
we're asking for them to do the impossible. So what we need to do is say, well, let's say we redesign banking. We make it possible for banks to combine the best elements of venture capital. So a bank can still create money, and gives money to entrepreneurs and what I call entrepreneurial equity loans. But then when they get the loan, rather than having a debt charge against the company, they've got an equity charge against it. So if the company gets wiped out, if 4 of the 5 fail, then the bank loses its money on those 4, the money it's created. But on the 5th, you can get a massive gain.
Exactly. Yes. Yeah. In other words, they have more of a much higher risk, but the reward potential for success could be far greater as well. And they don't have that upside on an entrepreneur-based lending. That's a very valid point. And the key point there was equity, and maybe even equity in the individual, so that even if he fails 5 times, they retain a certain equity in him. Is that taking it too far? Does that make a man a servant to a bank forever?
That's possibly pushing the envelope too far, but nonetheless, that basic idea, we need the best explanation for why banks should exist and why they should be allowed to create money was given by Schumpeter in a book called The Theory of Economic Development. And what he really saw banks being, they're what we call venture capitalists today. Now they're not that. They've become financiers of assets.
Home lenders, and financial engineers.
And the amount of lending they've lent is what's actually driven up the house prices. So the dilemma we have of house price affordability is entirely due to the amount of money that banks are able to lend to you to let you buy the property, because that actually levers up the price. Now, mainstream economics says that doesn't happen. That's almost an outright proof that it does.
Yeah. And how would you change that? You would turn them into part venture cap, part home loan.
Given the opportunity for venture capital, get them back to the days when they used to provide working capital for existing companies. They don't do that anymore. That's where the commercial paper market has come from, because banks made lines of credit too expensive. They make credit cards too expensive now, but we still take the damn things out. They've made lines of credit too expensive, so firms that need capital issue their own commercial paper rather than getting a loan from a bank. So get back to the stage where they do that as a potentially lucrative but revenue-based rather than asset-based lending. But then, create a means by which they can actually be venture capitalists, but cut out the property bubble. And my little idea on that is to say that we put a legal limit, not a regulatory one, but a legal one, that no more than you can borrow no more against a house than some multiple of the rental income we expect from the house. So I'll take the place I'm living in right now. I'm paying £18,000 a year to rent this little property. My rule would be that you could borrow no more than 10 times that, whether you were myself or you were Elon Musk buying the property. So therefore the levered maximum would be 10 times the rental price. And therefore, to buy a property against somebody else, you need to save more money than they did.
And you wouldn't be able to get beyond the natural income producing capability. You wouldn't be able to extend multiples against the income capability, which is a bit like capping the PE ratio on equities, for example, in a sense.
Fundamentally, that sort of thing. And what that means is that you would no longer have people competing for leverage. Whereas at the moment, as well as banks making profit by creating debt and doing that against mortgages and then creating asset bubbles, the public has an incentive to find the highest level of leverage when they're competing for houses with the same income. I want to break that link.
Exactly, and that's self-feeding. So that's a great one, and I like that. Talk to us about the debt moratorium idea. We have an existing situation, and we have a whole bunch of over-leveraged. What's your idea on how we fix that?
Yeah, well, if you look at where we are right now, we've probably got 2 or 3 times the level of private debt we should have.
Yes.
That's the scale we're at.
Are you talking generally, globally, UK, US?
Globally. I mean, the UK, this way, before Maggie Thatcher, the level of private debt in the UK never exceeded 73% of GDP. And when she took over, it was about 60%. And when the bubble I'm talking about now began in the UK, it was about 55% of GDP. From 82 on, it took off like a rocket, and it came down a bit at the 90 crisis and then rose again under Blair. But it rose from 55% at the time of the deregulation beginning to 195% of GDP, 3.5 times as much.
And now, this is private credit to everyday citizens.
Household debt and non-financial corporate debt. So
and it includes mortgages, everything.
Mortgages, but also commercial borrowing. That huge amount of leverage has been irresponsibly lent, and now the fact that you can't repay it is why the economy is in a funk. Now, we think about debt as if I'd borrowed your microphone off you and I don't return it to you, I've robbed you, and you had to save money, you had to save your own income to buy the microphone, etc., etc. So we think about bank debt the same way, but banks create debt just out of double-entry bookkeeping. Yes. You have come along with it, say, I want to buy this property. They say, that's great, here's £1 million, and by the way, you owe us £1 million, and it's literally bank entries. They haven't actually sacrificed anything to save the money, and they're using a social privilege to be able to do it in the first place. It is not a right they have in their own. It's not a right or a piece of marvelous technology they have that nobody else can possibly understand. Often they don't understand their own bloody technology. So it's just simply the social privilege they're exploiting. So we need to reset that. They've lent too much money for the wrong things. Yep. So we've got to get out of it saying, okay, let's reset it. How can we reset it? Well, just like banks create money by lending out more than they get back in repayments, the government creates money by spending more than it gets back in taxation. Now, its spending can be a social transfer. The central bank just as easily, in fact, even more easily than a private bank can record an asset by buying or creating an asset like an equity in the country and putting deposit directly into people's bank accounts, a modern debt jubilee. And so it's like a tax rebate, but the tax rebate could be quite substantial. And then that rebate would be, let's say they gave everybody £10,000, and myself £10,000 and Richard Branson £10,000. If you're in debt, then your debt gets reduced by £10,000. But if you're not in debt, you get a cash injection.
Yeah.
So that means people who speculated aren't rewarded over those who didn't. People who have cash.
But isn't it always the same? Those that weren't already in debt are only likely to save that money and do responsible, non-consumerist things with it. And the ones that are spenders will just be forced into debt retirement and may just do new spending because they've made new space on those credit cards to spend. So spenders will keep spending and savers will keep saving is kind of what I'm saying.
In fact, what you tend to find is if you look at the level of unsecured debt, look at credit card debt, it's risen and it's fallen over time, but there's been no exponential trend in the ratio of unsecured debt to GDP. So at an aggregate level, even though we have outrageous interest rates on credit cards and lots of people get caught in credit card traps and so on, when you look at the data over the longer term, there's no tendency for that to explode because you don't expect to buy that second-hand car and sell it for a profit later. Now, in housing, because you expect the price to rise, and the rise is driven by the debt leverage itself, people are willing to take on far more debt. So we've gone from levels of mortgage.
So we're fingering the financial engineering on the asset aspect, as the key problem.
So without that, you can rely upon people's individual responsibility, collective responsibility, generally speaking, average responsibility, that you won't get out of hand debt just because you pay people out of debt. Only secured debt drags people into wanting to take on more leverage.
Yeah. That's right. I get that now. And if we did that, you would then the repercussions would be: would we have an increase in economic activity because we would have a lot of people that have £10,000 or whatever the amount might be that has come their way? Do we not get a dilution, an instant inflationary effect because all of this money has immediately been created, and you get a bump in prices commensurate to?
That can happen, but of course at the moment central banks are trying to cause inflation and failing around the globe. So I'm saying here's a way to cause inflation that actually works. But again, the scale to which it occurs is something it actually monitors. I would like to reduce, like in the UK's debt level, I'd like to reduce it effectively by 100% of GDP. That big a reduction. But I'm not going to do it in one go because I'm not totally confident that this is going to be a magic pill. And I know that there'll be things, for example, like that money, if it got spent on imports, then you'd have a blowout in your balance of trade deficit, which is already dangerously high for the UK.
Okay,
so there's all sorts of things you need to test and check and see what the impact is, what's going to happen on the value of the currency as well. Would that cause a currency to fall further, which would not be a bad thing for the UK because they regard its currency as still overvalued, as John Mills argues. So there's all those sorts of elements that mean that let's do it cautiously. But we could do it cautiously and still have a major impact. And, of course, what I'm suggesting doing is to use the central bank's capacity to create money. Now, they've been doing it themselves, buying assets off the financial sector. If you look at the scale of QE in the UK, when it first began, they bought £200 billion worth of assets in the first year.
And isn't that who they serve, though, Steve? Isn't it? Don't you get the impression that they just distinctly serve the financial sector, and all this hand-wringing, oh, it's so frustrating, there's no trickle through or whatever. They can't seriously care. Why can't they? Could easily do this suggestion of yours direct to the consumer. Why do they insist on working through a set of institutions if it's not by design?
I think it's partly out of habit over the long term because, first of all, they always deal with the financial sector. When the main role of the central bank, apart from the interest rate setting role, is to buy and sell securities on behalf of the government off the private sector, and they're buying them off financial institutions all the time. So they've got desks which are dedicated to open market operations and trading and buying and selling bonds. So it's a very simple thing. So let's do more of that. Now, what I'm saying is that's something totally different, and that's use this capacity to pay the money into private bank accounts. And of course, that's not just a monetary operation; it's also a fiscal operation, because that would show up as a deficit, a government deficit. So there are institutional reasons why they've stuck with it. It's also habitual. They're used to thinking they need a big financial sector. The Bank of England has got better on this front over time, but they really think if the financial sector gets smaller, that's really bad for the economy. I reckon the financial sector is 3 times the size of what it needs to be.
I was just going to say on that point, can we stop on that? Because the financial services has become a disproportionately large percentage of every economy. I used to think of it as the oil in an engine. It's there just to facilitate and lubricate the real working parts of the manufacturing and the service delivery part of the economy. And it seems like the oil is the engine now. It's almost like the biggest working part. And I totally agree that we need a wholesale scaling there down. They need to be just trimmed right down to what the basics, as you say, social privilege. They've already been given a massive. It's almost like government and financial services have grown ever bigger on a sprawl that turkeys never vote for Christmas. They just expand. There's always a new project, a new plan. It gives more power and it hoards more resources. And it feels like 2 massive parasites, 50-kilo parasites on this dying cow, weighing them down, sucking on either side.
We all know the expression, the military-industrial complex, which General Eisenhower coined back in the 60s. I think we're actually suffering from is what I call the political-financial complex. And the politicians themselves look like they're great economic managers when there's a bubble going on, because the private sector bubble generates large amounts of tax revenue and cuts back government spending, and they look like they're balancing the books really well. And with this ideology of pushing for a government surplus, they think they're doing fantastically, and they're then effectively tied up in supporting and encouraging the financial sector. And of course, like in Australia's case, my own country, when I was there during their crisis, the government tried everything it could do to keep the banks continuing to do what led to the bubble in the first place. So there is a political financial complex, and we need to break that as well.
We have a couple of interesting schools of thought, and then I'm going to wrap with a couple more details on your Patreon site, Steve. So thank you for what you've done. So we have people, a lot of my viewers will have seen, Peter Schiff, who says things like the dollar's going to zero, which I can't quite agree with because all the currencies are in the same bag, and currencies are a relative value assessment. Big purveyor of bullion, but he sells bullion, so it pays him to say that. Mike Maloney, who's in a similar purveyor of bullion state, but somewhat more reasoned. Potentially inflationist than deflationist. Harry Dent is very strong on the demographics. I get very accurate. A lot of valuable comments. I've sat with him and spoken with him.
Okay, let's see.
Hey, Steve.
That's better.
Yes, so they have a bad habit of cycling down the bandwidth if you talk for an hour. So apologies for that. I'll just restate very succinctly what I said. The inflation-deflation argument between Maloney, Dent, and an opinion also from Peter Schiff and other commentators that have some traction. Which will come first? Will it be a reset fear, which is my personal bias, but maybe my opinion is not worth much, and deflationary, and then the responses will cause the inflationary events. In terms of timing for people that are trying to protect themselves, this is relevant. And should we care? Doesn't matter. And what's your take on the order? And if assuming the trajectory of current government's behavior continues without taking on your and mine crusades?
Well, my website, the original website that I still partially maintain, I call debtdeflation.com. So I think that makes it fairly obvious which area I'm expecting.
Yeah.
And the deflation, when I actually model this is where my mathematical modeling comes in. When I put my model of debt dynamics together, it turned out that even if you had a model in which the private firms were the only borrowers, so workers did no borrowing, the tendency was that the profit share remained constant, the share going to bankers rose, and the share going to workers fell. So workers actually ended up paying for the increase in debt by a reduced amount of GDP. And again, when I look at the price dynamics, the fundamental cause of inflation is wage rises exceeding labour productivity. Now, this combination means that wage rises tend to be below labour productivity, so workers get a smaller and smaller share. Deflation becomes the rule. And then, of course, if you have this huge accumulation of debt, and if firms who borrowed the money can't service it, and you have speculative borrowers as well, which I haven't included in that basic model, then you're going to get even more deflationary trends coming out. So the basic trend is towards deflation. And that's, of course, been amplified by the arrival of China and third world producers in general on the production scene. So the tendency, and you think about it, we have technological change going on all the time as well. Unless there's pressure from workers to get wage rises in excess of that increase in productivity, then you're going to have deflation as a basic trend.
Yep.
And because we've also had neoliberal policies screwing the trade unions and attacking union power, the outcome is even more deflationary pressure. So all this stuff has pushed prices down, and I think deflation is
and automation, which will affect the most blue-collar of workers hardest as well.
Right.
So in essence, that would be, and I concur with that opinion, and in that situation, debt will kill you, cash is king.
Yeah, fundamentally.
Any other assets that are worth holding? Properties will go down in price. Most things will go down in price, especially the financially engineered assets. Where do you hide apart from cash?
Well, I think the cash is about the only place you hide. And that's one reason I'm worried about this tendency of economists to try to abolish cash so that they can use negative interest rates, which is one of the craziest ideas they've ever come up with. But they've now got the technology to start talking about abolishing cash. And the reason I simply don't, they don't know what they're doing. I won't try. This is like handing over to somebody flying a plane who thinks there's rubber bands you've got to twist to get the propellers to turn. So I'm not about to let a cashless society come about while economists in command of the economy have such a naive idea of how it actually functions. So, but overall, cash is the security because you're outside the danger of the credit system, and then you can move even if the credit system itself freezes up.
Surely this could be melt up for cryptos, though, if you start to get wholesale acceptance and there's no interest concept and there's an alleged fixed number.
The danger of cryptos is twofold. First of all, the speculative elements themselves, and secondly, from what I've seen of Bitcoin, I don't know enough about the other blockchain technologies, but it takes about 10 minutes to verify a blockchain exchange on Bitcoin, and takes a fairly large amount of computing power to do it as well. That 10 minutes is just too long for capitalism. Now
the new altcoins, the new versions are dealing with that, the scalability, the fungibility, a lot of the issues. So there is there's quite quick movement in there.
Yeah. Well, they need to
and even Bitcoin may have to adapt as well.
They've got to move more quickly, and they've got to be more stable. Like one of the most important characteristics of a monetary system is even if there might be a general price inflation or deflation going on, the value of the currency doesn't change radically over time.
Yeah.
Now, that's just not true of Bitcoin at the moment or any of the cryptocurrencies. So
they're too volatile.
What?
But I would argue there's a life stage cycle in all of this. First of all, it's a punter's spec stock,
Yeah.
kind of like what penny stocks are for certain traders.
Yeah.
And the early dogs are in there. Generally, it's only upside. These braggarts make money, the early adopters.
Yeah.
It largely only is a long-only trade. In fact, those that sit more than they do trading make more money. It starts to become popular. It has a bit of a .com boom where everyone's buying boo.com and bridal.com type feel to it. People start waving in bigger amounts. What then happens is there's more issuance, there's more supply, slowly starts coming on. It starts to get in more balance, but it's still, instead of being hyperbolic, it maybe goes up quicker than it should, but more and more people are comfortable with it. It doesn't lose 50% in a day. It doesn't make 50% in a day. And then over time, as the normal curve hump goes into it, they become quite staid and quite bloated and fairly tightly balanced, and people are coming in and out, and the mania element is over, and then they start to replicate more of that of a currency, and it's just about who was early and who jumped on what was going up again, in that age-old adage that we were discussing early.
Yeah, but at the same time, a lot of people argue in favor of private competitive currencies, and a sort of Austrian argument about private banks competing with each other rather than being rescued by the government. And two problems I see with that. One is that one of the reasons money works is it's simple. Now, if you have to actually decide which sort of money you're going to go shopping with today, which one you trust and which one you don't trust, and which is in a bubble and which is not, it's just too damn complicated. There's enough complicated stuff even in your own family relationships not to need that on top of when you decide how to go shopping.
But think about it, Steve. We used to just go buy a pint of milk. Now you buy 2% full cream, whole cream, all of this. The world is unfortunately getting filled with choice. You choose how you spend your money. You have credits on your phone.
It's just too complicated, and people should think, get me away from the complications. I want something simple that works, and that's one reason that ultimately a fiat money system tends to come back in, even if there's people who are rabidly anti-fiat money. Is simplicity of it was what actually comes back and rules in the long term. So I still think we need a monetary system which is simple. And the idea of competing currencies, digital or otherwise, to me is not simple. It's a sign of chaos, and it will pass.
But maybe a certain slice of chaos in your portfolio pie is worth having in the same way.
We're talking an investment decision, not something about the amount of how you store money.
But that investment decision, it is a bit of a hybrid of investment decision and exchange.
Yeah.
In other words, you can cash it out quite regularly. So it's kind of like a cash instrument. Anyway, very interesting discussion. I like your views. I think you stay safely in the skeptic camp on the cryptos. I don't blame you. It's new. And it is a Wild West out there, and there have been some scary stories. But within that, I think it is also attracting quite interesting technology, and the banks are getting involved. One of them, called Ripple, has got, the longevity of PayPal and Western Union. When you use Ripple, you can pay within seconds, and it costs a fraction of a cent anywhere, from any account, anywhere in the country to any other country, to Ghana, to anywhere.
So I'll check that out.
Yeah, it's very, very powerful, and I think the big short has to be out in the payment companies like Western Union and even PayPal.
Yeah.
So watch out for that. The technology is there. So once again, Patreon, Steve Keen, the man who wants to fix our economic system, who wants to take the truth of how things really work to the economists that are hanging on to the social privilege we've granted banks. I really like the cut of his narrative, and I think we could do so much more better with this kind of thought. Steve, thank you. And also the book Debunking Economics and How to Avoid the Next Another Financial Crisis. I'll get there in the end. Can we avoid another financial crisis? Steve Keen. Go check out those books, both on Amazon. Steve, a parting shot for you before we call it a close. Anything?
No, I would just, again, I'd like to get the book itself, Can It Avoid Another Financial Crisis? It's only 25,000 words long. It was a rather special discipline to write it for such a short book and for such a non-technical audience. So I think I hope it has a fair bit of influence. To me, it's I'd like a lot of people to read it and reflect upon it, and hopefully we can get that to give us the mental capacity to break away from the current financial system.
Excellent. So the book is made for the man in the street reading. Steve's a smart guy. He talks at 100 miles an hour. This is slowly put down for you. It's clear. It builds on it. You'll come away with a proper understanding. Get the book. So go to the Patreon's page and give him some support. Let's help him along and get his voice heard. Steve Keen, thank you very much. Appreciate it, and especially late at night. And look forward to following your progress.
Thank you, Francis. Okay, bye.
All the best.
Okay, thanks a lot. I'll get off to get